Hey, Tim Harrison, Straight Up Mortgage Talk, and today we're going to talk about income to debt ratios and how they impact the loan process. So let's get started. So if you don't understand income to debt ratios, it's really going to impact your knowledge of what you can actually buy. That's why it's important. So looking at castles when you can afford a condo kind of sucks because you know what? You really like what you saw in the castle. Just saying. All right, so I wish I could tell you I did different, but I actually did this wrong when my wife and I were first looking, and I absolutely looked at castles before understanding income to debt ratios, and then had to settle for what I could really afford. So this is why I do this. 28 years of doing mortgages now, and this is how I help people really understand what you can afford. First, we look at your income, and we look at your gross income. You know, the part you never get to keep, like the actual dollars that show on your paycheck stub, but before everything comes out, we calculate a percentage of that income to debt ratio. And so what does that mean? We say normally that you can use 45% of your gross monthly income for the housing expense, principal, interest, taxes, insurance, and association, if there's association, plus all other minimum monthly payments, student loans, car payments, credit cards, things that would show up on a credit report. What we do is we say, okay, well, if they have this much house and it's going to be $2,700, and they've got another $500 in other payments, credit cards, student loans, whatnot, and it doesn't exceed 45% of that income to debt ratio, meaning they take the actual number, what are your total debts with the housing expense, divide it into the gross amount of monthly income, and if that doesn't exceed 45%, then that means you can afford to go that high. Now, you may not want to. You may think we're nuts, that payment's way too high, but that's how we're gonna qualify you. That's how we're gonna tell you what you could potentially go out there and look and buy that home. All right, so now you got a little information on income to debt ratios. Now, here's what to do. Call somebody like a mortgage professional who knows what they're doing. Doing so, figuring out what you can afford before you do like I did and look at stuff you can afford makes the process smoother and happier. Trust me, it's a lot easier road to travel. Thanks again, Tim Harrison, Straight Up Mortgage Talk.